Let's talk about the US dollar, the not-so-boring backbone of the global economy. It's more than just paper in your wallet or numbers on a screen. The dollar is the silent force that shapes the way the world does business, from the biggest corporations to your local coffee shop. For decades, it's been the world's reserve currency, the go-to for international trade and finance. Countries everywhere hold dollars in their central banks, and businesses rely on it to settle deals, pay debts, and measure value. It's the currency that connects continents and keeps the gears of global commerce turning. Oil, tech, and even your morning coffee are all priced in dollars. Whether you're filling up your car, buying a new phone, or sipping a latte, the dollar's influence is right there, quietly affecting what you pay and what things are worth. But as of June 2025, the dollar's grip is slipping. For the first time in decades, its dominance is being openly challenged by other currencies and shifting global alliances. It's losing strength, and that's sending shockwaves everywhere. Investors are nervous, governments are rethinking their strategies, and markets are reacting in real time. When the dollar stumbles, the world's economy feels it. Prices, power, and stability all get shaken up. A weaker dollar can mean more expensive imports, unpredictable markets, and uncertainty for everyone from CEOs to everyday shoppers. Why should you care? Because a weaker dollar means your phone, gas, and groceries could all cost more. The effects ripple out, touching your wallet, your savings, and even your travel plans. It's a global reset, changing fortunes for countries and people alike. Some nations may benefit, while others struggle to adapt. The balance of economic power is shifting, and no one is immune. The dollar's dominance has been so normal we stopped questioning it, until now. Suddenly, the world is waking up to just how much rides on the strength of a single currency. Suddenly everyone's asking, is this the end of an era? What comes next? Will another currency take its place, or will the dollar find a way to bounce back? This isn't doomsday, but it is a turning point. The world is watching, waiting, and preparing for what could be a new chapter in economic history. We're witnessing a fundamental shift in the world order, and it's happening in real time. Every headline, every market move is part of a bigger story unfolding before our eyes. The rules of global finance are being rewritten, and we're all part of the story. Whether you're an investor, a business owner, or just someone buying groceries, these changes will touch your life. So grab your popcorn. This economic drama is just getting started. The next act could change the way the world works, and you won't want to miss it. Why is the dollar stumbling? It's a mix of big debt, shifting policies, and global pushback. The US has piled up debt, making the dollar less attractive, like a friend who borrows but never pays back. The Federal Reserve, once raising rates, is now cutting them, so investors look elsewhere for better returns. Meanwhile, countries like China, India, and Brazil are trading more in their own currencies, challenging the dollar's supremacy. Political uncertainty in the US has shaken global confidence, prompting countries to diversify their reserves. It's like everyone's spreading their bets, not just trusting the dollar. The result? A perfect storm that's weakening the dollar's hold on the world. The trend is clear, the world is slowly moving away from relying solely on the dollar, and that's changing the game for everyone. What happens when the dollar weakens? It's more than just a headline on the evening news. It's a ripple that spreads across the globe, touching everything from the price of your morning coffee to the fate of international businesses. When the dollar dips, American exports get a boost. US goods become cheaper abroad, making them more attractive to foreign buyers. Suddenly, products stamped "Made in USA" are in high demand, and American factories ramp up production to meet the surge. Imagine your quirky lawn gnomes or classic blue jeans flying off shelves in Europe and Asia. Foreign shoppers are eager to snap up American products, enjoying lower prices thanks to the weaker dollar. But for foreign companies selling to the US, it's a headache. Their goods become more expensive for American consumers, so sales may drop, or companies are forced to cut profits just to stay competitive in the US market. Commodities like oil, wheat, and copper, usually priced in dollars, get more expensive for Americans. This can push up prices at the pump and in the grocery store, fueling inflation and squeezing household budgets. For countries that produce these raw materials, it's a windfall. They receive more dollars for the same barrel of oil or ton of copper, boosting their profits and sometimes strengthening their own economies. As the dollar's dominance wobbles, some countries look for ways to trade directly with each other, bypassing the dollar altogether. This shift is subtle but significant, changing the way global business is done. China and Saudi Arabia might settle oil deals in yuan, while India and Brazil could use their own currencies for trade. These moves signal a growing confidence in alternative systems and a desire for more control over their economic destinies. Around the world, financial markets are experimenting with new ways to trade, slowly chipping away at the dollar's central role. The global financial landscape is becoming more diverse and unpredictable. It's a move toward a more complex multipolar trading system, where no single currency calls all the shots. This new reality brings both opportunities and challenges for businesses and governments alike. The dollar's decline isn't just about numbers on a screen, it's about shifting power in the global marketplace. Who gets to set the rules and who has to follow them is up for debate. Every new trade deal outside the dollar is a step toward a new financial order, where countries have more say in how they do business and who they partner with. The old rules are fading, and new ones are taking shape. The world is watching as the financial playbook is rewritten in real time. The world's economic map is being redrawn, one transaction at a time. In this new era, adaptability and innovation will determine who thrives and who gets left behind. For emerging markets, a weaker dollar is both a relief and a risk. Dollar debts become easier to pay, freeing up cash for schools and infrastructure. But imports get pricier, driving up costs for food, fuel, and essentials. Inflation hits hardest for the poorest, sparking unrest and tough choices for governments. To fight rising prices, central banks may hike interest rates, slowing their own economies. It's a balancing act, helping government budgets but hurting everyday people. This volatility pushes emerging markets to seek alternatives, like trading in local currencies or building gold reserves. They're tired of the dollar roller coaster and want more control over their financial futures. These countries are leading the charge for a less dollar-centric world. Their actions are reshaping global finance, one policy at a time. The quest for stability is driving innovation and new alliances. The future of money is being built from the ground up. Investors are quick to adapt when the dollar weakens. The global financial community is always alert, watching for shifts in currency values that can change the rules of the game overnight. When the dollar starts to slide, seasoned investors know it's time to rethink their strategies and look for new opportunities. Americans look abroad. Foreign stocks and assets become more attractive and affordable. Suddenly, markets in Europe, Asia, and emerging economies offer better value for every dollar invested. This shift opens doors to new sectors, industries, and regions that may have been overlooked when the dollar was strong. If the euro rises, U.S. investors win twice: asset value and currency gain. Not only do their foreign investments appreciate, but the stronger euro means their returns are even greater when converted back to dollars. It's a double benefit that savvy investors are eager to capture. Meanwhile, global investors holding U.S. assets get nervous as the dollar's value drops. Their returns shrink, and the risk of further losses grows. This uncertainty prompts many to reconsider their exposure to U.S. markets. They start shifting money to other markets: German bonds, Japanese stocks, or gold. These alternatives are seen as safer havens, offering stability and potential growth while the dollar remains under pressure. This isn't panic, but a careful rebalancing of trillions of dollars. Asset managers and institutional investors are methodically adjusting their portfolios, weighing risks and rewards in a rapidly changing environment. Less demand for U.S. Treasury bonds means the U.S. must offer higher interest rates, raising borrowing costs for everyone. This impacts not just Wall Street but also Main Street, affecting mortgages, business loans, and government spending. The era of easy, cheap borrowing in America could be ending. Higher rates make it tougher for families to buy homes, for businesses to expand, and for the government to finance its debt. A weak dollar creates a feedback loop. Investors leave, the dollar drops more, and confidence is tested. Each move away from the dollar adds pressure, making the situation more volatile and uncertain. The dollar isn't being abandoned, but it's no longer the only game in town. Other currencies are gaining ground, and investors are diversifying to protect their wealth and find new growth. Investors are preparing for a world with several major currencies. They're building strategies that can thrive in a more balanced, multipolar financial system where no single currency dominates. Where their money goes, global power follows. The flow of capital shapes which countries and markets rise in influence, and which ones face new challenges. The financial landscape is shifting, and everyone's watching where the smart money moves next. In this new era, adaptability and global perspective are more important than ever for investors seeking success. For borrowers worldwide, a weaker dollar is a game changer. Countries and companies with dollar loans suddenly find it easier to pay back what they owe. National budgets stretch further, funding health, education, and growth. Struggling businesses get a lifeline, avoiding bankruptcy and layoffs. But for American lenders, repayments are worth less. Future loans may come with higher rates or in other currencies. This could spark a shift away from dollar-based lending, with more loans in euros, yuan, or baskets of currencies. The US loses some of its exorbitant privilege as the world's banker. The global debt system is being restructured, making crises less likely to start in Washington. It's a move toward a more balanced, resilient financial world. The fate of nations is no longer tied so tightly to the dollar's ups and downs. The BRICS nations, Brazil, Russia, India, China, and South Africa, are accelerating the dollar's decline. They see the current system as unfairly favoring the US and want more control. Their solution? Trade in their own currencies and build new financial institutions. The new development bank lends in local currencies, bypassing the dollar and the World Bank. Every deal settled outside the dollar weakens its dominance. The BRICS aren't trying to destroy the dollar, but to create a world where several currencies compete. It's about economic sovereignty and protection from US policy swings and sanctions. Their push is both a cause and effect of the dollar's weakening. The global financial order is becoming more balanced, one BRICS deal at a time. Technology is rewriting the rules of money, just as the dollar's power wanes. Central bank digital currencies, like China's digital yuan, are making cross-border payments faster and cheaper, bypassing the dollar. The US is exploring a digital dollar, but others are moving faster. Digital currencies could let countries trade directly, cutting out the dollar as middleman. Cryptocurrencies and stablecoins offer alternatives outside government control, appealing to those wary of inflation or debt. The future will be a hybrid dollars, digital currencies, and crypto all sharing the stage. The definition of money is changing and the competition is fierce. This tech revolution is colliding with global power shifts, making this a pivotal moment in monetary history. So, what does all this mean? The dollar isn't vanishing overnight, the US economy is still massive, and the dollar will remain a key player. But its monopoly is ending. We're moving to a world with several strong currencies. This could make the global system more stable and resilient. Multiple currencies mean more checks and balances, and less risk of one country dragging everyone down. It's a chance to rethink how money works and who benefits. The economic order is a human creation. It can be changed. The story of the dollar is a window into our changing world. The ground is shifting, but that's how new opportunities emerge. We're all watching and shaping the next chapter of global finance.